Welcome to Leading Indicator. I'm Anne Berry, and joining us today to discuss where to find the next AI opportunity and the state of play for the pharmaceutical industry is Michael Mossessian, Managing Partner at StockGeek. Michael, thank you so much for joining, and right in the heat of an earnings week that is just filled with two of these topics that are just hitting the headlines already. Let's start with artificial intelligence, with AI. Enthusiasm for that technology was a key factor behind the tech rally, particularly towards the end of 2023, throughout the year, particularly in that second half of the year. And it was a big reason, Michael, why NVIDIA was the S&P 500's best performing stock. We're still seeing AI being emphasized as an opportunity, whether it's Tesla, whether it's Meta. Talk to us a little bit about how you're viewing the AI opportunity in the public markets right now.
Sure. And Anne, thank you very much for having me on. It's a pleasure to be here. Look, AI is a very complicated topic. When it comes to pure play AI investing, there actually aren't that many opportunities available. Really, a lot of what people are looking at are stocks like NVIDIA, as you mentioned, which are really AI adjacent. And there are lots of companies that were big gainers last year exactly in that space. Of course, there was NVIDIA. There was also Broadcom, which surged on its acquisition of VMware and had some pretty decent multiple expansion, was a big hit among the top performing hedge funds last year. Other opportunities like Intel, AMD, the chip makers, TSMC, ASML are all great ways to get into the AI opportunity. Unfortunately, when it comes to pure play companies, we saw this last year. Early last year, actually about a year ago in April, Hindenburg released a very compelling short report on C3 AI, which was for a long time kind of the publicly traded darling in the AI space. They're a big sponsor of NPR, for those of you who listen, right? But Hindenburg made some pretty big accusations, about kind of serious accounting and disclosure issues, citing audits from Deloitte that may have been incorrect in some way. Of course, the AI company denied it, as they all do. But there are some non-systemic factors to consider with regard to AI companies. Of course, with it being such a new space as well, there's a lot of risk in companies that are brand new, seeking private investment, looking for different opportunities across the board to raise capital from retail investors as well. But all that is to say that basically, looking at AI adjacent companies is probably the best way to go, because they're going to be the most exposed to continued industry trends and really the big CapEx cycle we should see in the next couple of years of significant investment flowing into these companies.
Michael, it's interesting when you've listed the companies that you've talked about as AI adjacent, the names that you've brought up so far as ones that you've been more enthusiastic about have really skewed towards hardware companies. You listed a lot of chip companies. You talked about VMware. What about in the software space? And a notable omission from your list were the Microsofts and the Googles and the Amazons. Talk to us about where those fall in your lineup.
Yeah, absolutely. With regard to software, again, it's kind of hard to say. The real software leader, or at least web-hosted software leader that we've seen, is OpenAI, right? OpenAI, I don't see them going public anytime soon. They certainly don't need the money, and there are certain corporate governance rules in place that may prevent them from seeking outside investment from public markets, especially with their substantial investment and ownership stake from from Microsoft, rather. And of course, that brings into play other competitors who are interested in kind of the chatbot space. When it comes to software in general, right, there's been a lot of development here and big competition for competent engineers coming over from one company to the next. We saw it with the kind of OpenAI board reshuffle that was very temporary, Sam Altman's exit, and then immediate return. And really, what's interesting is that Sam Altman can kind of be viewed as the leading indicator of what's going to happen in AI. And so this announcement last week that he's been going around the world looking for investment to develop his own chip fabs that will work and develop chips specifically for OpenAI hardware is a big revelation, right? And he's not the first to do it. Google has already announced similar plans to do this, as has Amazon, I believe, and so has Microsoft. So they've already looked into developing. They've looked into developing their own hardware for their own AI efforts. So even though software is the big deal right now, in order to expand that software's reach to bigger and bigger markets, hardware is really going to be the story this year.
Michael, you've touched on a trend that we have seen grab a lot of headlines over the last 12 months, which has been these big publicly listed strategics like Amazon, like Google, like Microsoft, investing in some of these private companies, whether it's OpenAI, to your point, Anthropic is another one. So when you think about trying to get exposure to AI that it goes outside of hardware, what are your thoughts on trying to pick between Microsoft, Google, Amazon that are in turn investing in some of the biggest and perhaps most promising AI software businesses? Is that a way to get access to those, or would you just not include that in your investment thesis?
I would certainly include it in my investment thesis, but I would pitch it with kind of a corollary point, a caveat here, if you will, which is the debate around AI is very concentrated around the moral implications, the societal implications of this technology. And you have two very opposing voices on either side. One side, which is Elon Musk, who was the original founder of OpenAI with Sam Altman about 10 years ago, is voicing for control, regulation, really thinking about how AI is going to impact technology, jobs, society as a whole. And then you have people at Google like Sergey Brin who are just like all in on AI. They don't care what it does. They just want to make the most money as possible. So if you're concerned about what AI is going to become over the next few years, I think, as you should be if you're considering investing in this space, you should also really think about what those companies want to do with that AI. And so to your point, right, there's a lot of companies making all these acquisitions here. And of course, it's one thing to look at the acquisitions that they're making. It's another thing to look at how they deploy that technology down the road and what they also do with that investment, right? Google is kind of famously known for being a graveyard of startups, whereas Amazon makes very strategic acquisitions that are going to absolutely expand its market reach to different, with different technologies. And so that's another thing to think about is what will this company really do with that tech? Is it going to be a major part of its business lines? Are they going to somehow integrate it? Say, will Amazon integrate any kind of AI into AWS or other consumer services they may start launching? Or is it just going to be this pure play business that's sitting on the side, like, kind of a hobby like Jeff Bezos with Blue Origin, right?
Well, I think specifically though with Michael, just to push you a little bit on this, the Googles and the Amazons and the Microsoft have been very clear that the reason they're investing in these private businesses to get exposure is to learn and ultimately integrate AI features into their core offerings. I think they've been pretty explicit that the intent is to make sure that they're commercializing this technology. So I really want to just push on this question again, which is, the retail investor is hearing, again, it's a lot about OpenAI, it's a lot about Anthropic, there are a couple of others. Do you think that the Alphabet share prices, the Microsoft share prices are inflated, for better or for worse, and would love your perspective on that, by virtue of their exposure to these more glamorous AI privately held names?
My initial inclination is to say yes. I think there has been a bit of a fervor and multiple expansion with regard to AI exposure in big tech companies. What really remains to be seen is how far out it takes for these businesses or these business units to become highly profitable for these companies. Whether or not they're going to require outside capital or significant capex in software engineering or sort of just a ramp up or even sales to get these products out the door remains to be seen. And it's still going to be a question of, is leadership at this company seriously committed to making this a viable, profitable product line? Or is it something they're talking about and committing to as a 3-5 year cycle to get shareholders excited about staying with their company?
Well, we'll find out. We're going to hear a lot in these earnings calls this week, Michael, when we hear, I think, some of these CEOs really talking about, and I think are going to be pushed by the street to talk about what the profit model is going to be for a lot of these technologies. Let's shift gears a little bit, Michael, and talk about the pharmaceutical industry. Another one that's been grabbing the headlines over the course of the back half of 2023, a lot of it when it comes to drugs like Ozempic that are geared towards the diabetes and obesity markets. Talk to us about what you're seeing as top trends in this industry.
Sure. Yeah, the pharmaceutical industry is very interesting. As you've said, obviously, we have some big earnings coming up, Pfizer being one of them, reporting tomorrow. The pharmaceutical industry, I think, is quite fractured now, where there's sort of three avenues of approach. One is kind of fighting rare diseases with new novel treatments. The other is COVID, or was COVID, which we're now seeing a big differentiation on in terms of what companies are devoting their balance sheets to. And the third is kind of those GLP-1 inhibitors like Ozempic, Wegovy, et cetera. Those products are obviously really big. I personally don't view Ozempic or Wegovy as huge long-term opportunities, simply because at some point everyone's just going to get skinny. It sounds silly to say, but at some point, right, either health effects are going to start taking a toll on people, or people will just realize that, hey, there's healthier ways to lose weight, and at some point everyone's just going to be on it. However, that's not to say that there aren't companies that are involved in GLP-1s that aren't doing other interesting things in other areas, right? And when it comes to pharmaceutical investing as a whole, and this is something that hasn't changed over the last few years, is there's kind of two schools of thought. You can either invest in highly profitable growth companies, or you can trade and speculate on new approvals, like a number of hedge funds that exist, one of them being Perceptive Advisors. Joseph Edelman and Adam Stone at Perceptive do a really good job of finding public and private companies with promising treatments and pharmaceutical tech in development, and they're able to research all of that and make those decisions because they have a team of highly competent individuals, biologists, researchers, former doctors, et cetera. But for the vast majority of people, taking a growth approach is probably better. So what you should really consider...
Can I just pause you there, Michael, on growth? Because I want to just go back to one of these points you made. Let's just go back to Ozempic. And I think I heard you say you're not long-term bullish on that because at some point everyone's going to be using it. But I just want to make sure I'm following your logic. If your argument is that the Ozempics are going to have such market penetration and such reach, then what you've described, which is a massive adoption, is a massive revenue opportunity that isn't at all being contemplated in the share price right now. So am I hearing that you're long-term bearish, but that would make you a massive bull on that opportunity over the near term while that penetration's happening?
I'll put it this way. Eli Lilly on a comp sheet looks very bad, right? All of their fundamental indicators, especially things like EV to sales, EV to EBITDA, are multitudes higher than their competitors who are also producing similar drugs or getting into the space. So although, yes, there should be some level of greater adoption, I think there is a point at which the market becomes so saturated with GLP-1s and that the people who are using them will eventually stop using them because they will lose their weight, right? It's not a permanent drug. It's not something that you can take for the rest of your life. It's not an ADD medication per se, where once you're diagnosed, it's obviously your choice, but most people will continue to take it for most of their life. Same thing with the antidepressant market or similar long-term conditions, right? Chronic disease. Obesity with the aid of GLP-1 is not going to become a chronic condition anymore. So at some point, companies will have to pivot to new ways to market to that same group of people.
And how far away is that some point, Michael? And we've got a global market in front of us as well.
We have a global market in front of us. That's true. And there are things to consider, like the size of, the diabetes treatment market in the United States. I would be foolish to make a long-term prediction and talk about years out. That's really not what I try to do. But when I think about Wegovy and GLP-1, I think there are more interesting technologies in the pharmaceutical space that companies that are not as overvalued as Eli Lilly are developing, with more promising growth prospects than one drug. And that's really where I'm viewing the pharmaceutical industry this year.
Let's talk about what some of those other focus areas might be. Cancer treatments is one that's been getting a lot of conversation. Michael, you said, the COVID focus is over and its sort of attention has shifted. Talk to us a little bit too about for some of the other large pharmaceutical treatment areas where we're seeing more opportunity, and particularly where US companies are perhaps seeing some of their biggest drugs rolling off patent, because that's a big protector of profits coming under pressure.
Yeah, absolutely. Patent losses are a big deal this year, and they'll continue to be for a number of years as a lot of these drugs, as you mentioned, roll off patent. So really R&D spend and the resiliency and the deployment of that R&D spend is going to be a great way to look at companies that are potentially looking to offset those patent losses. One company like that, it's not American, it's English, Anglo-Swedish, it's AstraZeneca, who have spent a long time, the last about 17 years, developing a very interesting antibody drug conjugate, which is an alternative cancer treatment. It's taken orally. It's an alternative to chemotherapy, and they've had a couple of different drugs, and Enhertu and Imfinzi being two of them, that have shown real promise in treating all sorts of inoperable cancers: lung cancers, gallbladder, liver, pancreatic cancers, digestive cancers, etc. They've had widespread approval in Japan, are gaining approval in the United States. There have been some hiccups along the road, but generally speaking, right, it's a very positive development. AstraZeneca spends 20% of its sales on research and development. And although they're not nearly as big as Pfizer, right, on a fundamental basis, they're actually quite interesting. Speaking to the cancer market specifically, a lot of different economists and sources are projecting anywhere between 10 and 20% CAGR through 2030 in the cancer treatment market, especially in alternatives to chemotherapy. And AstraZeneca really has been so far poised to take advantage of that. But when you look at kind of broader fundamentals, there are other interesting companies outside of cancer, like Sanofi, that could be considered a strong kind of hedge against other conditions, offsetting patent losses, especially being one of them.
Let's get your final thoughts, Michael, just on another area of the healthcare market, and that's medical devices. Talk to us a little bit about your perspective on that part of the wellness space.
Yeah, medical devices are really, really fascinating. Before I worked in the public space, as I do now, I worked with some interesting private funds that specialized in distributing medical devices and actually securitizing the accounts receivable for the use of these specialized medical devices. So we're talking about like neurosurgery or cardiovascular surgery robots, really specialized procedures that take several hours and are confined to a small number of clinics in the United States or Europe that can actually perform these operations. And there's a couple of interesting companies, Medtronic, Stryker, Zimmer Biomet. All of them are developing different alternatives to robotic surgeries and procedures. And although I wouldn't say AI will be involved in this, it certainly could be considered a corollary to that, where we're seeing more and more technological intervention in operating rooms and in more complicated procedures with highly trained surgeons who are able to manipulate these devices. And as we get into considerable, medical procedure advancement, and with chronic disease on the rise, necessitating perhaps more cardiovascular surgery, more neurosurgery in the future, we're looking at a strong opportunity for a more widespread implementation of devices like these, all of which are manufactured by really a small number of companies, mostly Bosch, like I said, Stryker and Zimmer Biomet, who are all sort of competing in the same robotic surgical space for a very big share of the market that they haven't really penetrated very much.
We'll be learning a lot more about that space again in coming weeks as this earnings season continues to roll forward. Michael Mossessian, managing partner at StockGeek. Thank you so much for joining us. That's it, folks. Joining us for our next episode of Leading Indicator.